The drop in the non-performing loans or bad loans is promising good times to the borrowing public, with banks now more willing to lend. This comes on top of a fall in the willingness of commercial banks to lend due to, among others, a spike in non-performing loans since 2016. In 2016, the ratio of non-performing loans to the total loans given out hit 8.3%, one of the highest points in years. Because of the high risks assumed by lenders at the time, the growth in loans was only 0.9% compared to 3.7% the previous year. This was followed by a more lackluster performance in the subsequent years. But the economy today appears to be emerging out of the slump.
One of the things that we've noted over the last almost 1.5 years is the recovery in credit. This has been good for the banking sector, and I can understand the view taken by the bankers that this has been good for business. And it is good to hear. Even the private sector is sending a message that this period has been good in terms of access to loans.
There are several factors cited for this state of affairs.
The economy is projected to be operating around its potential economic growth of between 6 and 6.5% per annum. The upturn in the Ugandan economy since the beginning of 2017 is expected to continue, partly supported by accommodative monetary policy, higher growth in government consumption and investment, strong pickup in private investment and consumption, and improved agricultural performance.
The central bank has also helped support this stance through a monetary policy strategy sitting between inflation targeting or control, but at the same time signaling monetary easing, encouraging banks to lend. It has, for instance, maintained the benchmark rate for April at 10%.
The current level of the CBR is consistent with the Bank of Uganda's policy stance of maintaining inflation around the target of 5% per annum while supporting economic growth.
While the picture appears bright, it's not yet time to relax as economic stability threats appear not far from us.
In particular, a combination of slower global growth, weather-related constraints to agricultural production, delays implementing public investment programs, and a weaker shilling could dampen Uganda's economic growth.
Our trade, our exports, for example, declined in the 12 months to Feb. That could be partly a reflection of the global economic development. But also because the global economic softening is both current and projected, some of the impact will feature as we go along.
A combination of factors have today helped the banking industry post fairly good performance, with the leading player, Stanbic, firmly plowing in 215 billion in profits after tax last year. In turn, this has improved the industry's willingness to lend. Question, though, is how far will this state of affairs last?